Welcome to our 2016 webinar series. This year, timing is everything. This year, we'll be telling your clients stories just when you need to hear them and share them with your clients. After all, when you tell a story makes all the difference. If I told the three little pigs to a group of 5-year-olds, it would be a fable. If I told the story of the three little pigs to a group of general contractors at a conference, it would be a case study. And if I told the story of the three little pigs at a summer campfire with a bunch of preteens, it would be a scary Cujo story. And if I told the story of the three little pigs on a first date, well, there probably wouldn't be a second date. Each month we'll tackle fears your clients have about income security and wealth preservation using innovative and creative insurance solutions. This month we'll focus on annuities and hybrid solutions, specifically by declaring freedom to worry from living too long or worry about spending down assets. This month's series will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. And since timing is everything, please ask questions as you have them by typing them in, and we'll do our best to answer them as they come in. Today's story is being recorded and will be posted on our website within a week in case you've missed any of the plotline. And throughout 2016, like the saying, the more you read, the more you know. The more you watch, the more CFPC credits you'll earn. You can earn 8 credits, one for each month. Today's storyteller can tell you dozens of stories. He joined LLIS in 2008 and has 20 years specializing in annuity solutions. And now to tell the story, Independence Day, help your clients celebrate independence from worry, Jerry.
Thank you, Claudia. I hope everybody enjoyed their 4th of July weekend that we just had. But, sorry here, there we go. When we think of the 4th of July and independence, we think of fireworks, Statue of Liberty, our independence from governments. But today, we're really going to talk about independence from retirement. Now, who wants freedom from retirement? I know I do. I view my retirement or picture my retirement to be on a beach in the Bahamas. My lovely wife sitting in the chair, me swimming in the ocean. Only thing different with this picture is instead of having a basket of fruit, we'd probably have a cooler full of beverages there. And also, I picture myself being a professional cornhole player. That's me practicing in my backyard. But as we've seen, a lot of us have probably seen this commercial. A lot of people don't like the idea of retirement and talking about it and planning for it. This commercial shows a couple doing everything they can possible to avoid talking about retirement. They're creating chores so they don't have to deal with it. 76% of your clients, they're stressed out when they think about retirement. And a large part of that is because they hear all these people who have not saved anything for retirement. This number is astonishing to me. 45% of Americans have saved exactly nothing towards retirement. We all know it's coming. We all know we can't work forever, but yet there's people out there who do absolutely nothing to save for retirement. Now, this is obviously none of your clients, but it may be people that your clients know. And also, only 22% of workers are confident they have saved enough for retirement. With preparation and working with trustworthy advisors like you, your clients won't be fighting against the wind. They will be enjoying it. So today we're going to talk about how fixed deferred annuities, immediate annuities, QLACs, annuities when they're inherited, and long-term care hybrids can all help your clients in retirement. So let's take a look at how fixed deferred annuities can help. So why purchase a fixed deferred annuity? Well, there are several reasons, but one, as your clients are aging, they don't really want to deal with the volatility of the market. A fixed deferred annuity is going to give them a steady interest rate that they can count on every year. Maybe they want to lock in the gains that they've been able to achieve by investing in the markets. Or they just simply want that guaranteed rate of interest that they're going to get. And also, because everything's guaranteed with a fixed deferred annuity, they're going to be able to guarantee an inheritance to their beneficiaries or their children's if they don't spend that money themselves. So here is Mary Kay. She's a client of an advisor who came to us, and Mary Kay had 2 variable annuities. One was worth $325,000, the other was worth $102,000. Mary Kay was tired of the ups and downs of the market, and she wanted something more secure. So what we did with Mary Kay is we actually did a ladder approach. Kind of like how you can do ladder with bonds, you can do the same thing with fixed deferred annuities. So what we did is we got her one annuity for a 6-year rate, and we put $90,000 in it. At the time, that annuity was earning 4.25%. We did 2 7-year annuities with $112,000, both earning 4.6%. Why did we do 2 of them? We just wanted to spread the risk out between the 2 companies. And then finally we did a 3rd annuity for an 8-year rate with $112,000. So we split up her money over 4 different annuities, giving her that laddered approach. And then as those annuities come due, we take a look at where interest rates are compared to what her current interest rate is in the annuity, because most of these annuities, once you reach the end of that rate period, you can leave the money in that annuity, go into and earn the guaranteed minimum. So a lot of these annuities may have like a 1.5% guaranteed minimum, and when you have no surrender charges for a 1-year rate, that's a pretty good rate right now in the market. So a lot of times as they're coming due, we've kind of just been letting the annuities sit there. So I'm often asked, what are the current interest rates? Well, here they are. I just looked these up yesterday. As you can see, a 10-year is going to pay the client about 2.7%, or we can go as short as 3 years and earn 1.35%. But the sweet spot right now is really sitting at that 5-year rate where they can get 2.25%. Now, I know that doesn't sound like a lot, but when you compare it to CDs or what you're going to earn in a money market, that is a good rate that your clients can earn. Now, one of the things I've heard since I've been working in the insurance industry, and as Claudia said, it's been right around 20 years, is that interest rates are low, they're going to go up. Well, when we look at this chart, ever since 1984-85, rates have been decreasing. So all this time that I've been working in the industry, that rates are low, they're going to go up, it hasn't happened. And in fact, when you look at everything that I'm reading today, is that the Fed may increase rates, they may not increase rates. None of us know what the Fed's going to do with interest rates. In fact, I'm getting notifications right now from insurance companies that they're already going to be decreasing rates. A lot of times insurance companies will decrease rates on the 1st of the month. I'm getting notification that on the 15th they're going to be lowering rates again, and they just lowered them on the 1st. So right now our current trend is rates are still going down. So independence from worry about paying the bills. Clients are worried about living too long. What if they live too long? What if they run out of money? Is a very big concern a lot of clients have. So, and that's where immediate annuities come in, because it's the one annuity that can guarantee your clients they will not run out of money. So here we have Sarah and Pam. Pam is actually the mother of Sarah, and Sarah is a financial advisor. So Sam came to me one day and said, you know, her mom's retired. She's actually 75 years old, and her mom's worried about running out of money. So Sarah asked me, what should I look at for my mom? Well, first question we kind of talked about was, does she want guaranteed income? And her mom did. She didn't really want to be invested in the market, didn't want to have to worry about any of those ups and downs. She wanted a guaranteed income. She wanted basically to recreate that paycheck she had when she was working. Well, then we talked about, does she have any old annuities or life insurance? Her mom did not have any of those. Does she want to lock in any gains? And she did. She had seen some appreciation over time of her investments, and she wanted to lock in those gains. Does she tend to be conservative? I asked And yes, her mom is definitely more conservative now. And does she need income within the 12 months? And she did. She wanted to start the income actually immediately. So then we talked about, well, how much guaranteed income should her mom purchase? Well, generally, what I always say when you're looking at an annuity to buy, to provide that income, you want to cover some of those fixed expenses that the client's going to have every day. And for Sarah's mom, we wanted to make sure her mortgage or her rent was covered. We wanted to make sure her electricity and her water was covered. We also wanted to make sure that, she wasn't going to go hungry, that she had enough there to pay, to go out and do grocery shopping. And we also wanted to make sure that any of her insurance premiums were covered also. We don't want to let those policies lapse. So we kind of looked at those and added those up to see like what her expenses were. Then we started talking about which payout option would be best for her. Well, with an immediate annuity, there are several different payout options you can choose from. You have period certain payout options, which are for non-life, and then you have lifetime payout options. So with a period certain option, what that basically means is that it's going to pay, that annuity is going to pay for a set period of time. So for example, if you buy a 10-year period certain annuity, that annuity is going to pay for 10 years. If the client lives beyond 10 years, then well, that annuity is stopping at the 10th year. If they die before the 10 years are up, well, that annuity is going to continue to make payments to a beneficiary until it's fulfilled those 10 years worth of payments. Then what is probably the more common type of payouts from annuities are lifetime payouts, and there are several different options. Well, the one that's going to provide the highest payout to your clients is the life-only payout. This is going to pay as long as the client's alive, and once they pass away, the payments are going to stop. Well, then we can add on different guarantees onto that payout, and whenever you add a guarantee on to a payout, that is going to decrease the payouts to the client. So you can do a life and a period certain payout. So for example, let's say you do a life and a 10-year period certain payout. So what that means is that annuity is going to pay for the greater of the life of that client or the 10 years. So let's say they purchase the annuity, they're receiving payments, and they pass away in the 8th year. That annuity is going to continue to make payments to a beneficiary for the next 2 years to fulfill the 10-year certain part of that payout, and then the payments will stop. If the client's receiving payments, they live to, say, the 11th year and then pass away, the annuity is going to stop. We're beyond the 10 years of that 10-year period certain. The life with installment refund and life with cash refund option are my two favorite options. Those guarantee that whatever premium that is put into the annuity is going to be paid out. So let's say, for example, a client puts in $100,000 into the annuity and they pass away after $80,000 has been paid out. The installment refund option is going to continue to make payments to the beneficiary until that other $20,000 has been paid out. The cash refund option will write a check to that beneficiary for that $20,000. Now, if the client's receiving payments and they've received $100,001 in payments and then they pass away, the payments stop. It's fulfilled the installment or cash refund option. You can also do all these payout options as with a joint person. So you can add a spouse on, could be a significant other, they don't have to be married, but you can add a joint person on and you can have all those payout options, life with period certain, installment refund, cash refund options. We can even reduce the payment to the survivor also. All of those affect how the payouts are going to be initially. I can work with you to determine what's best for your clients. So going back to Pam, who is 75, we decided that, we're going to put in $250,000 into the immediate annuity, and we looked at 3 different payout options. We looked at life only, life and 10-year certain, and life with installment refund. And as you can see, as the guarantee is as a guarantee is greater on those payouts, the payout is a little bit lower on them. Now, I'm also often asked, well, what is the interest rate that insurance companies are crediting on these immediate annuities? I wish I knew. For those of you who knew me from my prior life, I came from the home office of an insurance company, and I was actually responsible for marketing immediate annuities to fee-only financial advisors. Even when I worked in the home office of the insurance company, I did not know what the interest rate was that they were crediting on the inside of the annuities. There's a lot of factors that go into that, and because of that, insurance companies just don't publish that rate. But what I can do is calculate, kind of a rate of return based on life expectancy. And for Pam, as you can see, life only, her rate of return would be 3.93. Life and 10-year certain would be 2.31, and life installment refund would be 2.11. Now, of course, if Pam lives beyond life expectancy, well, those rates of return go up. So in Pam's case, we decided to go with the life and 10-year period certain. Now, one of the other options that you can do with immediate annuities, you can add on a cost of living adjustment. And you have two options with that. You can either do an increasing payout option where that monthly payout is each year will go up by a fixed interest rate, or you can have it where it's marked against CPI-U, not CPI, but U is an urban index, so it's a subset of CPI. So it's actually a little bit lower than what CPI is. There may only be one, maybe two companies that still offer that. Most companies do offer an increasing payout option, and you could generally get that anywhere from 1 to 5% increasing each year, but 3% is the most common. So we looked at that for Pam. So in year one, being at age 75, her annual income without any inflation payout is going to be $23,848. If we add inflation on, that payout drops down to $19,079 a year. But that payout is going to increase by 3% each year. We fast forward to year 9, that inflation adjusted payout has now finally greater than the level payout. So it took 9 years for that payout to grow to that point. And just so everybody knows, the average life expectancy for someone who is age 75 is about age 89. So the next 5 years, Pam is actually going to receive higher income if she lives to life expectancy. But when we're really trying to evaluate, should we do inflation or not, we got to really look at what the cumulative payout is on the annuity. And when we look at year 9, our level payout is still higher than what it is for the inflation payout. The level would have paid out $214,000. Our inflation adjusted would have paid out $193,000. We actually go out all the way to the 16th year when Pam would be 91 years old for where that cumulative payout is greater than what the level would be. And lo and behold, it's actually in this case beyond her average life expectancy. So one thing, when you're considering adding inflation onto immediate annuity, I normally really only recommend it in one or two situations. One, if we got to put a majority of a client's assets into an immediate annuity because they need that guaranteed income. And when I say majority, the most you can input into an immediate annuity is 50% of a client's investable assets. That's the most you can put in. Also, the only other time I would really recommend it is if the client has longevity in their family. Their parents have lived well into their 90s, so that client may actually do better with an inflation adjusted. So another question I often get asked about with immediate annuities is, should we wait to purchase it? So Pam at age 75, should she wait to age 80 to buy the immediate annuity? Well, so at age 75, for $100,000 payout, Pam will receive $8,759. If Pam waits to age 80, that same $100,000 would pay her $10,389. She would get an extra $1,630 a year by waiting to age 80, but what Pam gives up is over $43,000 of income over those 5 years. So just waiting to age 80 to get a higher payout is not a good deal because our break-even age is 106, and we know she is way beyond life expectancy. But the one thing we haven't looked at is what if interest rates go up over those 5 years? Well, how much do they actually have to go up for Pam to break even? Well, a 10% shift in the yield curve will yield about a $60 a year change. So that could be 10 basis points up or down on the yield curve is going to make a change of about $60 per year. So the break even at age 85, so if she receives payments at age 85, those interest rates would have to go up about 1.8% over those 5 years. What we've seen with interest rates lately, not likely they're going to go up that high. So kind of the moral of the story is that when your clients have a need for guaranteed income, the best time to buy it is at this time. So now we're going to change gears and we're going to talk about QLACs. So independence from taking as much RMDs. How many of you have clients that are receiving a pension, they have Social Security, they turn 70 and a half, they're receiving enough income from those other sources, and now they have to start taking RMDs. So now they're getting more income in and creating more of a tax burden on them. This is where QLACs can come in and possibly help with the situation. So what is a QLAC? It is a qualified longevity annuity contract. It's a cross between a deferred annuity and an immediate annuity. As the name kind of says, it can only be purchased with qualified funds, and it's a way to supplement retirement solutions and guarantee a payment stream in the future. So kind of the nitty-gritty with a QLAC. Well, they're only single premiums. The IRS is nice and they allow us to put this money in this product, and one of the nice features of it is that the money that goes in, you don't have to take RMDs on it. So if you have a client who is 70 and a half, they put money in a QLAC, that money is removed from calculating from their RMD calculations. But the IRS is nice, but they're not going to be super nice, so they're going to limit how much the client can put into the QLAC. And what they do is they set that limit at is the client can put in up to 25% of their qualified accounts, not to maximize $125,000. So basically, if your client's qualified accounts total $500,000 or more, the maximum they can put into a QLAC is $125,000. Also, you cannot put any Roth money into this policy. These annuities are going to give you a guaranteed income stream that's going to start in the future. So you have to defer them 2 to 30 years in the future, but you cannot defer it beyond age 85. Also, the payout options are limited on it. You're limited to life only or life and cash refund. And there is a death benefit available. It will provide either a lump sum or an income stream, and we're going to touch on that in a little bit more in a minute. But it's the tax benefits it provides. The value is excluded from RMD calculations, which can reduce the taxes that your client's going to have to pay. So here we have John, who is 70 and a half, and he must start taking his RMDs on his full $500,000 he has in his qualified accounts. So John, he doesn't really want to have to take RMDs to start with, but because the IRS is saying he has to, he talked to his advisor and was asking about ways on how he can reduce taking RMDs. So I'm working with the advisor. We talked about the QLAC, And this is what we did. We took $125,000 from his $500,000 and we put it in a QLAC contract. Then what that does is that reduces his qualified assets down to 375, and then this is now what John has to base his RMDs on. It's this $375,000. That's the balance of his IRA assets. So what John did is we looked at the various payout options. We had single life, and we looked at with a death benefit and without a death benefit, and we looked at starting payments at age 80 or 85. So with a death benefit, and what that basically means for John is that if he dies before payments begin, his beneficiaries would get the $125,000. If you do without a death benefit, if he dies before payments begin, the insurance company keeps the money. But as you can see, there's a difference in the payouts. We'll look at age 80 here. With a death benefit, his payout would be starting at age 80, $2,392. Without the death benefit, it would be $3,189. So a substantial bump in that payout. And if you notice, if we go to age 85, that increases even more. Why is it so high? Well, because once you get out to about age 85, we're kind of at John's life expectancy, so there's a 50-50 chance he'll still be alive to even start receiving the payments at age 85. But we also looked at the cash refund option. First thing you're going to notice is that there's not much of a difference. Well, that's because some companies are better at life only, some companies are better with cash refund, and this is actually two different companies here that I use to get these numbers. And you'll notice with the cash refund option, you could only get that with a death benefit. IRS says that if you're concerned about making sure you're going to receive your money back when you start receiving payments, you probably also want to make sure that if you don't live long enough to receive payments, you're not going to lose that money either, and that's what the cash refund option is doing here. So independence for my annuity beneficiaries. So we're going to change gears here, and we're going to talk about clients who inherit an annuity and what are their options. So Jane is a client of an advisor, and she inherited an annuity from her mother. And you see money coming up from the grave. So Jane has three options when she inherited the annuity, and this really goes for any of your clients. They basically have three options when they inherit non-qualified annuities. Option one, they can take that lump sum payment. They have to pay taxes on any gain. The death benefit gain is taxable, so a lot of annuities, will show they have a death benefit. Well, the death benefit on an annuity is not like a death benefit on a life insurance policy. Life insurance policy, it is all tax-free when it's paid to the beneficiary. An annuity, anything over the original cost basis is taxable to the beneficiary. That's why annuities are one of the worst things to leave to a beneficiary, because they have to pay taxes on it. But if you take the lump sum, you can do anything you want with the money. Option two actually has a 2A and a 2B. So we can stretch the payments over 5 years. So the IRS says, well, you don't have to take all your money right away. We'll even let you leave it sit in the annuity for 5 years. But at the end of that 5 years, you have to take all that money out of that annuity. Why? Because we want to receive our income taxes on that money. So once again, withdrawals, any withdrawals that are taken out of the annuity, the gains will come out first, and that is true of any annuity. Anytime you take a withdrawal out of an annuity, the gain comes out first. Or you can annuitize it over 5 years, and we can spread those gains out over 5 years. And then option three is we can annuitize it over the lifetime of the beneficiary. And what that does is that spreads those gains out over the life of the client. So in this case, the annuity value is $260,000. but the cost basis in the annuity was $129,415, meaning that there was a taxable gain of $130,000 on this annuity. So let's take a look at the three options that are available. So one, we could stretch the payments over 5 years. Remember, withdrawals, the gains are going to come out first. So in year one, we take out $52,000 and it's all taxable. Year two, we take another $52,000 out and it's all taxable again. Year three, we take out the $52,000. $25,000 of it is going to be taxable and $26,000 of it's going to be tax-free because we finally reached the cost basis part of it. And then in years 4 and 5, the withdrawals would be tax-free because we're just withdrawing the basis out of the annuity. Or option 2, what if we stretch the payments over 5 years? So we're going to annuitize it over the 5 years. Therefore, we're going to spread the gains out over 5 years. So our payment each year is going to be $53,741. Of that, $25,903 is non-taxable and $27,838 is taxable. It's very easy to plan around this. You know how much is going to be taxable each year, and you know how much you're going to receive each year. And then option 3, annuitize over the lifetime. This is probably the least common option that clients use because most clients, they view when they inherit an annuity as a windfall. But we have done this sometimes when the clients work with the advisor. So in this case, our payments are going to be $15,393 a year, of which $5,000 of that would be non-taxable and $10,000 of it would be taxable. And that's going to happen for the first 25 years. In that 26th year, only $115 going to be non-taxable because we will have received all of the cost basis back by that time. And then from years 27 on, every payment will be fully taxable to the client's beneficiary. So Jane has options. She can take a lump sum or she can SIP on it. The lump sum, pay the taxes on the gain all up front and do anything she wants with that money. We could stretch those payments over 5 years. Those withdrawals are going to come out first and those gains are going to be taxable, or we can annuitize it over the 5 years, spreading those gains out over the 5 years, or she can annuitize it over her lifetime, spreading those gains out. So what Jane actually elected to do is she decided to annuitize it over the 5 years because she wanted the money because she viewed it as a windfall, but she didn't want that tax hit all in that first year, so she spread it out over the 5 years. So now we're going to change gears again and we're going to talk about hybrid policies. Independence Day. Clients, if they need long-term care, they want to be independent and don't want to have to depend on their kids, or it could be Independence Day. Here we have Superman wearing his Depends. So a lot of your clients believe they are not going to need long-term care insurance. In fact, 22% believe they will never need long-term care. And most of them grossly underestimate how much long-term care is going to cost. I'm sure all of you have seen a difference in your clients. They don't want to talk about long-term care. They don't view it's a big deal. And then either somebody they know or, God forbid, one of their own parents needed care, and then the reality hits them of what the cost is, what's the likelihood that they're going to need care, and their whole opinion on long-term care changes. In fact, 70% of people of age 65 or older are going to need long-term care at some point. Now that care can be just 2 weeks, maybe 3 years, it might be 10 years. That's the million-dollar question. How long are they going to need care for? And unfortunately, we don't have a crystal ball that we can look in and see how long that need's going to be. So there's two types of long-term care insurance clients. There's ones that traditional long-term care policy is going to be appropriate for them. And then there's the clients where the hybrid policy is going to work for them. So the traditional long-term care policy is more appropriate for clients who cannot self-insure. You know, maybe they only have $500,000, $600,000, $700,000 of retirement assets. If they had a long-term care event, it's going to wipe out a vast majority of their savings. And God forbid it's the first spouse that needs this care. Then there's going to be no assets left for the second spouse. Maybe they have sizable assets in qualified accounts. You know, so if they have to start tapping that qualified assets to pay for long-term care, taking out huge amounts of money, that's going to be a huge tax burden to them if they're doing that. Or they have retirement income coming in. You know, they're fine in retirement, but maybe they have limited liquid assets. You know, so maybe they have their house, maybe they have, you know, a summer home, or maybe they own investment real estate assets that aren't liquid for them. The hybrid customer, they're the client who wants to self-insure. They have the assets to do that. They have large lump sums of money, non-qualified assets where they can self-insure. And they want to leave a legacy and assets to their beneficiaries. And they have those non-qualified retirement assets that they can use. So what we're saying is let clients be free to decide their own care. And let the clients be free from the state. So here we have Sandra, who is 63. She's saved $500,000 for long-term care, and she wants to leave money to her kids. So Sandra has this $500,000. If she needs care, oops, wrong key, sorry. If she needs care, that money is going to go to the nursing home and nothing's going to be available to go to her kids. But what if we look at option B? That same $500,000, and what if we split it a little bit and we look at a long-term care insurance policy? That $150,000 goes to that long-term care policy, and if care is needed, all of that goes to the nursing home. And she's still able to leave $350,000 to her kids. So what we did for Sandra is we looked at two options of hybrid life for her since she has a single premium. And by the way, hybrid life policies really work best when we're able to use single premium money. So what we're going to do is we have the $150,000, and that is going to be invested into a hybrid life policy. What we're looking at here is the Lincoln Money Guard policy. Putting $150,000 for Sandra in this policy is going to give her a monthly benefit of $6,591. Not only does it do that, but it's also going to give her a 4-year benefit period and 3% compound inflation. This really looks like a traditional long-term care policy. In fact, I always refer to this type of policy, it's really a long-term care policy with a life insurance wrapper. It smells and looks just like a traditional long-term care policy, but it does provide a small death benefit. In fact, we're going to put in $150,000 and our death benefit is only $158,000. So this policy is really designed to maximize the long-term care benefits. But also, it doesn't end there. If the client purchases this policy and they change their mind, after 5 years, they can get 100% of their premium back if they want. So it provides long-term care benefits. It can provide a death benefit, and they can get their money back if they want. It's a very versatile and flexible policy. So let's take a look at how this works. So Sandra purchased this policy with $150,000. She's 63 years old, and it's going to give her a monthly long-term care benefit of $6,591. It gives her a long-term care pool of $316,000. So right off the bat, her $150,000, we've doubled the amount of money she has for long-term care. And also, in that first year, if she decided she wanted to surrender the policy, she could still get $120,000 back. If we fast forward to age 80, her monthly benefit has grown to almost $10,900. Her long-term care pool has grown to $522,000. I mean, that same $150,000 is now going to provide her $522,000 of long-term care. Her death benefit has stayed the same, and if she surrenders the policy, she can get her $150,000 back. So let's take a look at how this policy works if she goes on claim. So Sandra's going to go on claim, and she's going to use the full amount that she can use every month. So she's going to use $130,000 a year. Now with any hybrid life policy, not just a Lincoln policy, but we're using a Lincoln as an example, when a client goes on claim, any money that policy pays out for long-term care benefits is subtracted dollar for dollar from the death benefit and from any cash value in the policy. So in Sandra's case, at the end of age 80, her long-term care pool has been reduced by the $130,000, her death benefits reduced by the $130,000, and her surrender value, her return of premiums reduced by the $130,000. So at the end of age 80, if she was to die, her beneficiaries would receive $27,000 as a death benefit. Or if she decided to surrender the policy, she would get the $19,000. And then this will continue. So if we looked at the next year, her long-term care pool would be reduced by the $130,000, actually be a little bit more because it's going to grow by 3%. It would be reduced again. Her death benefit would be wiped away. She'll have a small residual death benefit. I think it's around $7,000. And there would be no return of premium available to her. So, but what if she thought, well, the hybrid life policy is nice, but I don't like the idea of having life insurance, or maybe her health is not the greatest. So we look at hybrid annuity for her was the second option we showed her. What's really nice with the hybrid annuity is that a lot of clients that are not able to qualify for traditional long-term care can still qualify for the hybrid annuity. It is the most lenient product for underwriting when it comes to long-term care insurance. So why are these policies attractive? Well, they're great for clients who are closing in on that retirement age, or they're planning to self-insure. I'm going to show you how those clients who want to self-insure, we can give them a much bigger long-term care pool by just reallocating some money. And they're going to get all the benefits of self-insuring, but with a bonus. So with the hybrid annuity, it's like having your money do double duty. So we're going to repurpose $150,000 of money that Sandra was setting aside for long-term care expenses, and we're going to reposition it to a hybrid annuity. If they don't need any long-term care, the death benefit of that annuity, which is going to be equal to the account value, passes on to her kids. In life, if she needs access to that $150,000, she can take 10% out of it free each year. There is a 9-year surrender charge on the annuity. If she needs money after 9 years, she can take the whole value of the annuity. It's just like a regular fixed deferred annuity. And if she needs long-term care, that's where it gets interesting. So let's take a look at the options for Sandra. So if she wants to self-fund, she can put 150,000 and we're going to be nice and say she's going to earn 1%. So at the end of year one, her self-fund account will have grown to 151,500. Now with the hybrid annuity, we have three options with it. So you're always going to have your $150,000, and the difference between the three options is the long-term care rider on the annuity. It's going to extend the long-term care benefits for either 36, 72, 108 months. So if we look at here at option one, our $150,000 we put in, her account value is worth $150,400. Not a lot of growth. And if we look at option two and option three, her account values actually went down a little bit. We're all adults. We know nothing is free in this world. Well, as with this annuity, there is a charge for the long-term care rider in this annuity. And as you'll see, if we come down here to our long-term care pool, that with between option one, option two, and option three, that pool is greater. Therefore, option three compared to option one, the cost for that long-term care is going to be greater because we have a larger long-term care pool. But the long-term care is your long-term care with this annuity is calculated with between two accounts. We have this long-term care accumulation value. What this simply is that's the original premium put in the annuity, and it grows at a little bit higher interest rate than the cash value. So when your client goes on claim, it's the long-term care accumulation value that is depleted first. Once that is depleted, then it changes over to the long-term care rider. So let's take a look and see how this is going to work. Well, first, at age 80, here are the values. So our self-fund account has grown to $177,000. Our option one, our account value has grown to 152, almost 153,000. And as we expected, option two and option three, our cash value has continued to decrease a little bit. But you got to remember, that's not why we're buying the hybrid annuity. It's not for the cash value or the account value of the annuity. We're buying it for what it can provide for long-term care. So we really want to look at what the long-term care pool is. And you can see at option one, it's $389,000. If you go to option three, it's $811,000. So that $150,000 on option three grows to $811,000. Provides a long benefit period. Depends on what's appropriate for your clients. But so what if Sandra goes on claim at age 80? And she needs $6,200 a month. So we're just going to focus on her self-fund account and option one to keep it simple. When she goes on claim, she's going to use $74,400 a year, and in our self-fund account, that's going to be subtracted directly out of that cash value. And also, since our cash value is equal to our long-term care pool, it's subtracted directly from there. With the hybrid annuity, that $74,000 is going to be subtracted from the cash value and the long-term care accumulated value dollar for dollar. So both of those numbers are decreased by that. And since our long-term care accumulated value went down by the $74,400, our total long-term care pool value also goes down. You'll notice our long-term care rider has not been affected at all. We go to year two, we're going to stick where we're going to take on claim for $74,400 with our self-fund account. That's subtracted dollar for there, and it affects our long-term care pool. And the same thing happens from our cash value and our long-term care accumulated value. So you'll notice our cash value is very little, so if she decides she wants to surrender the annuity at this point, she'll get the $4,131. When we go to year three, this is where we see the true benefits of the annuity. So you'll notice we no longer have enough money in our self-funding account to pay that $74,400. She's actually short $45,000. So how is this going to be paid? Well, she's either going to have to dip into other assets to pay this, or God forbid, if she has no other assets, she's either going to have the state take care of her, or she's going to have to turn to her kids to get this money to pay for that. But with the hybrid annuity, that same $150,000, yeah, our cash value has been depleted. Our long-term care accumulated value has been depleted. But this is where the rider kicks in and starts taking over for the annuity. And that is subtracted dollar for dollar from there. And now our long-term care pool has been reduced to $166,000. And she's going to get still another 2 years and maybe a month or two out of this annuity to take care of her with this for long-term care. So what do these hybrid policies do? Well, they provide freedom that other rainy day assets can't provide. You know, clients who want greater than a 1-year elimination period on a long-term care policy, these hybrid policies are meant to do that. So they're like having a 2-year elimination period. So the first 2 years, you're going to use your own money if you don't have any type of long-term care insurance. Then long-term care benefits start with the life insurance. With the annuity, you still have the 2 years where you're going to use your own money first, and then the long-term care benefits start. So we've talked about fixed deferred annuities, immediate annuities, QLACs, annuities when they're inherited, and long-term care hybrid policies. All these products provide freedom to your clients when they enter retirement, helps them enjoy their retirement more, and it's just one of the quivers that you have available to show your clients to help them be independent in retirement. Now, top 10 things that make LLIS different than other services out there. Well, one, we provide these monthly webinars to you. And as you see in August, we're going to be talking about Season of Change, Protecting the Planning. We're also not your competition. The only thing that we do, we talk to your clients about is what you're recommending to them. We don't do money management. If you refer a client to us for term insurance or a hybrid policy, we're not going to turn around and talk to them about whole life insurance or talk to them about disability insurance. Our only clients are you, fee-only financial advisors. Ways we save your clients money is we pre-underwrite the heck out of stuff. We want to avoid surprises. Nobody likes a surprise, especially when a client's in underwriting and premiums come back higher than what they are. On our website, if you haven't had a chance to go to it, go to LLIS.com. We have an advisor's tool section on there that has a lot of useful tools to help you, the advisor, with insurance. We are proud sponsors of all these organizations that are in the fee-only planning world. We have product specialists in life, disability, long-term care, annuities, and hybrids. I am your annuities and hybrid specialist. I also specialize in life insurance. When your clients get insurance through us, we keep you in the loop with our AIM system. For those of you who haven't had a client apply with us, once your client enters the underwriting process, you should very rarely have to contact us to see what's going on with their application, because you're going to be updated automatically through emails. And what's great about these AIM emails is they're going to list out every step that your client is going to go through in the underwriting process. And not only does it do that, it tells you approximately how long each one of those steps are going to take. And what's great is as each one of those steps are completed, we send you the email letting you know it's been updated, what's the next step they're on, and you can see how long it's going to take. And not only do we manage your clients' policies both now and in the future with our APE system, we're going to let you know 30 days in advance before your client's premium is going to be due, to let you know to be on the lookout for that premium notice. And this goes to you and the client. It's amazing how many clients have moved and they don't tell the insurance company. Having these emails go out have greatly cut down on the number of policies that have lapsed because of people moving and not receiving their premium notices. All right. time for questions. I think I have a couple of them here. Let me take a look. Let me just say, okay. How difficult is it to get hybrid life policies? You're going through, kind of look at it, well, it depends on the policy. If you're going through like a policy like the Lincoln policy that we talked about, it's underwritten more like a long-term care policy would be underwritten. There are hybrid policies out there where they're more focused on death benefit, and the long-term care benefit is 2% of that death benefit. The underwriting on those are more geared towards life insurance, and they do a little extra for that long-term care component of it. But once again, once your client completes their telephone interview, or if we're able to get some health information up front, we can generally determine whether or not we feel they're going to be able to qualify or not for it. Can you use IRA money to fund a hybrid policy? No. It has to be non-qualified money that's used to fund it. Boy, do I wish we could use IRA money in these policies. Okay, I am used to seeing examples of long-term care that shows the projected gross cost, but not the net after reduced other expenses, including taxes. What percentage should a single person or a couple insure against? Well, what we generally do is when we're quoting clients for long-term care insurance, we'll look up what the average cost of care is in their area, and then we generally recommend using about 80% of that number. The reason for that is one, your clients in retirement have budgeted for some of the costs that are calculated in that total cost when we're looking up average cost. So they're already, those costs are looking into, you know, food and some staple items that your clients already budgeted in. So that's why we reduce it by 80%. Now, if your clients are receiving guaranteed income, like maybe they're getting pension and Social Security, you as an advisor can help bring those numbers down with that. We look to the advisor to help us calculate those numbers and kind of hone in on what exactly is that right amount of long-term care for them to have. Can we access the slides from today's presentation? Yes. We will send the slides to you if you ask for them. And I don't see any other questions. Does anybody have any more? I'll give it about another 10 seconds to see if any more come in. If not, well, thank you, everybody. This has been fun. I hope everybody learned something, and if you have questions, you know, feel free to give us a call at the office. We'll be able to help you however we can. Thank you, and everybody have a good night.